current conflict between Russia and Ukraine is going to have a terrible humanitarian cost. So let's hope that this can be avoided and peace prevails. War was declared on Thursday, the 24th of February, and share markets around the world reacted with dramatic falls. The Dow Jones Industrial Average was down 1.4%, nearly 500 points, while the S&P 500 lost 1.8%, the tech-heavy Nasdaq lost 2.6%. In Australia, the ASX fell 3%. However, that being said, some countries have actually increased in value in the lead up to this conflict, such as South Africa, which has actually increased by 6%, Taiwan, which has increased by about 4%, and the UK, which increased in value by about 1.5%. The Russia Capped Index Fund peaked in October last year and has fallen by about 30% in value. So by looking at past market data, we can not only see how the stock market is going to be impacted, but also how markets can be impacted in other ways, such as through tariffs, banking regulation, and export costs. Investors often ask themselves whether there's a link between geopolitical events, such as the current conflict between Russia and Ukraine, and the performance of the stock market. And whilst we did see these falls in the share market last Thursday, when we actually look at previous geopolitical events over the last 60 years, we actually find that sell-offs are typically short-lived, and returns over the following 12-month period are in line with typical stock market returns. Research from Vanguard shows this across many geopolitical sell-offs, from the Cuban Missile Crisis in 1962 to the Iraq War, and finally the Brexit vote in 2016. And what's really remarkable is that when you look at the average response to those events 6 and 12 months later, they're generally positive, with a 5% return 6 months later and a 9% return 1 year later. Only one event, which was the President Nixon impeachment proceedings, resulted in negative returns 6 and 12 months later. More broadly, you can see that 75% of geopolitical and military events resulted in a positive S&P 500 performance 12 months later. Only negative events which resulted in a negative share market performance 12 months later included the Suez Canal crisis, Arab oil embargo, and 9/11. But these are only 3 out of the 12. So what is it about these particular events that resulted in them having a much longer lasting negative impact on the stock market compared to other events? Well, it helps to understand how the share market reacted to each individual event. The Arab oil embargo started in 1973 when certain Arab nations, including Saudi Arabia, put an embargo on oil. It was targeted at Western nations, including Canada, the UK, the Netherlands, and the US, for their support during Israel during the Yom Kippur War. Typically, an embargo means the partial or complete prohibition of trading a certain product in certain nations. This caused the price of oil to skyrocket from $3 a barrel to $12 a barrel. But you can see the initial share market fall followed by a very quick initial recovery. But then there's this prolonged negative effect where the share market didn't really do anything for another 6 to 7 years. This secondary share market effect was because of the very negative impact that this had on the US economy, due to high oil prices, inflation spiking, and then eventually the 1979 second oil crisis. Whereas Pearl Harbor resulted in an initial downturn followed by a rapid share market bounce back. Following World War II, the United States emerged as the world's strongest superpower because it managed to come out of that war relatively unscathed, unlike Europe and Japan. So the key takeaway here is to not necessarily look at the event itself, but rather the economic impact of that event, particularly whether it's going to be long lasting. Fear is what drives that initial reduction in the share market. But if there's eventually new headlines, then that fear eventually dissipates. If you plot all of these historical events against the performance of the S&P 500, you can see that many of these events just really have an invisible effect. And what really dominates here is that long-term growth trend of the share market. Regardless of all of these disasters, the share market just continues to climb over the long term. Although we see the Suez Canal, Arab oil embargo, and 9/11 having a longer impact on the share market, for greater than 1 year, you can still see the long-term growth trend. This suggests that such events may instead actually represent short-term buying opportunities. That is, getting quick during the initial sell-off and then just wait it out. Because statistically, in the long run, it's likely to go up in the long term, and therefore represents an opportunity to profit as an investor. But some of these events do have a bigger long-term impact, and that's because they have an impact on company earnings. Looking at the S&P 500 profits, you can see that these longer-lasting crises are those which have a more detrimental and longer lasting impact on company profits. And after the Arab oil embargo, earning growth was essentially flat for almost a decade. And after 9/11, there was only a short dip and a sharp rebound in company earnings. And even the Iraq War actually resulted in earnings increasing. That being said, no one would want to invest right before the Suez Canal crisis, and then having to wait 10 years for earnings growth to increase again. The direct effect of the Ukraine and Russia conflict is still too early to analyze, but the indirect impact via inflation could be very significant. And that's because Russian exports are really at the core of this inflation spike that we're seeing. This spike in price comes from energy and also used cars. Russia also exports rare earth minerals, which are used in catalytic converters in cars. Another potential consequence is the increased spike in car prices. This could actually make the inflation situation worse and potentially result in the Fed raising interest rates sooner than what the market is currently anticipating. And that's something markets won't be happy with. For example, Brent crude oil, which is the global benchmark of oil markets, surpassed $100 a barrel after the conflict started. Oil has climbed a lot in the past year, and its price also determines things like airfares, fuel, transportation, and food prices. The cost of living in the US rose by 7.5% in January of this year compared to a year earlier, a nearly 4-decade high. Economists at Moody's Analytics estimate that higher inflation is also costing the average American family an extra $276 a month. This stems from higher prices across a range of products, including petrol. Americans are now paying $3.50 per gallon compared to the pandemic low of $1.77. And according to travel company Hopper, both domestic and international airfares are expected to rise by the first half of 2022 by an average of 7% a month through June, and customers can expect to pay around $350 a round trip domestically. But it's not just airfares, we also need fuel to plant and harvest crops. Farmers in the US are expected to pay $16 billion in fuel and oil expenses in 2022, a 35% increase from 2020. In January this year, the Consumer Price Index for food rose 7% compared to the year prior. Much of that increase is due to the higher price of transporting that food from farms to our shelves. This also applies to other products that are transported by ship, truck, and trains. Oil is the main commodity that just really impacts every part of the supply chain and is therefore going to have a big impact on inflation. And these higher costs are likely going to get passed on to consumers. So how much of an issue will this be for the US? If you look at petroleum consumption in the US from the 1950s, you can see that it only has traditionally been reliant on oil imports. The blue line is how much oil the US consumes. The brown line beneath it is how much of this oil is produced in the US domestically. So the difference between the two therefore needs to be made up by importing oil, particularly from the Middle East. However, since the mid-2000s, the local production of oil in the US has increased dramatically. And this was because of the shale oil revolution, which refers to the emergence of hydraulic fracturing and horizontal drilling that enabled the US to significantly increase local oil production from tight oil formations. This new production capability has resulted in the US being less reliant on importing oil from other countries. So the net imports required to meet local demand consequently fell as well. The US annual net trade of crude oil traditionally has more imports than exports at the start of the 2000s. But in 2010, the trade of petroleum crossed zero, meaning it imported and exported the same amount of petroleum. And now in 2022, it's exporting more petroleum than importing it. And although the US still exports more crude oil than importing it, the reliance on imports has decreased substantially over the last 20 years. So therefore, energy producing companies in the US may actually benefit from this conflict if the price of oil increases. Inflation is a really big topic this year when it comes to investing, and many people are thinking about how they can manage their portfolio in this environment of high inflation and potentially high interest rates. If you're interested in knowing more about inflation, interest rates, and their potential impact on the stock market for this year, then you can check out my other video here. Russia's main export is crude petroleum, refined petroleum, and other coal products. They also produced and exported minerals, including aluminium, copper, gold, and finally wheat. And here is where Russia mainly exports to. And you can see that it's mainly Europe, so the Netherlands, Germany, Italy, and the UK, and also Asia, including China. Russia is the third largest oil producer in the world, and they make up 11% of the world's total share. Russia also makes up just over 40% of natural gas imports into the EU, which is why they created the Nord 2 pipeline against the Nord 1 pipeline, along the bottom of the Baltic Sea, which effectively allows them to sidestep Ukraine. So the aim here is for them to actually increase their supply of natural gas to Germany and the rest of Europe. Consequently, Germany has now deemed the Nord 2 pipeline to be illegal, and the US has also imposed sanctions. The final impact on markets is going to be through the sanctions imposed on Russia. The idea of sanctions is to make life very difficult for Russia and the cost of war very expensive for them. At the time of making this video, the US and the EU have agreed to cut off certain Russian financial institutions from the SWIFT banking network, which just basically acts as this intermediary and payment executor between financial institutions worldwide. The problem with this, though, is that many European banks have actually lent money to Russian financial institutions. So they therefore won't be able to receive those payments back if those Russian institutions become locked out of the SWIFT network, which is what the chair of the Financial Stability Board is warning in this article. Banks which have lent money to Russian companies include Raiffeisen, OTP Bank, UniCredit, Societe Generale, and ING. I probably didn't say half of those right. But for example, OTP Bank gets almost 10% of its revenue from Russian businesses. To give an idea of this scale, the Raiffeisen Bank is a major Austrian banking group, and it's also listed on the Vienna Stock Exchange. These banks can also act as intermediaries between Russian businesses and other European banks, which in turn would create more problems for the European economy. However, we don't really know how much exposure to Russian banks and businesses other European banks have. And many of these sanctions are actually imposed on individuals, particularly Russian oligarchs, although the SWIFT sanctioning may extend to other financial institutions in Russia. The main target include the Russian Cyberbank and VTB banks, with the aim of disrupting their business operations in the West. Russia is also a major exporter of rare earth minerals, including palladium, platinum, and rhodium. Palladium has increased from $1,800 per ounce in January to over $2,500 on February 24th. Palladium is a crucial component of catalytic converters in cars, which convert up to 90% of harmful gases in auto exhausts. There's also a concern for chip makers, as neon is a key mineral that's used in the lasers that are used to create semiconductor chips. And 90% of neon supply comes from the Ukraine. The biggest semiconductor companies have reacted negatively to this news, with Intel, Taiwan Semiconductor Manufacturing, and Qualcomm falling 3 to 5% respectively. The cost to produce these chips is therefore likely going to increase and be passed on to consumers. So whilst markets do eventually recover from geopolitical events, there is a concern that this conflict could lead to ongoing inflation spikes for consumers. Inflation is something that markets are currently worried about, and it could lead to the Fed raising interest rates faster than originally anticipated. That being said, when Russia invaded Crimea in 2014, Buffett said in an interview with CNBC that despite the conflict potentially leading to World War III, you still need to invest your money in something over a period of time. One thing that you can be quite sure of is that the value of money will go down. So the last thing he said that anyone would want to do is to hold their money. During World War II, the stock market advanced. Historically has always advanced over time because American businesses are going to be worth more in 50 years' time than they are today. And since that interview, the S&P rose by 130%. Thank you for watching.